So there's a lot of cost associated with understanding that industry and trying to figure out where it's going, as opposed to just sitting back and tracking it. So that's the reason why the cost associated, I think, with the two are so contrasted, because there is a lot of time, effort and energy that goes into try and pick these things. And
welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Bills, here we are. How you going? Back again.
Andrew, back again. Favorite day of the week. I think I say that week in, week out. Talking on the podcast to you, bringing lots of value.
I thought it was just talking to me. It had nothing to do with the podcast.
To our viewers and to our listeners. But really enjoying
Shoot right past that one.
That's it. Very excited about today's topic. Andrew, what are we talking to everybody about today?
Yeah, so today we're talking a little bit about two different investment schools. So we're talking about active investments and we're talking about index investing. Now, both of them have had their day in the sun. And, I feel like it's what's the, flavor of the, I don't want to say year, it's almost like a flavor of a decade. Like, active investments are really good for a decade and everyone's all for that. Then index investments are really good for a decade and everyone's all for that. So we're going to compare and contrast it and chat a little bit about what it is and how they differ from each other. And we're also going to speak a little bit about your main man, Warren Buffett.
Oh, now you've definitely got my attention, Andrew. So I did see that in the notes that we've got. So looking forward to that part. But no, there is so much literature and information around active versus passive. So hopefully, from our perspective, we just give it a short, sharp, succinct brain dump, essentially, in terms of what it is, how we think about it, how does it fit in certain portfolios, what's the pros, what's the cons, do it a little bit of justice. So if anybody's confused by the terms or not sure what's appropriate for them, hopefully this helps with a little bit more information so then they can make a better or more informed decision, or at the very least get a bit of a knowledge increase in terms of the different investing styles. So Andrew, pick one. Where do we start?
Yeah, I mean, look, I think the easiest way to think about it is, and what is a passive versus active investment? And passive, index, two kind of interchangeable terms. Yeah. But an index investment is basically a fund. It's usually done in a fund, and the way that they do it is just put money into the largest assets in a particular sector. So not all index funds are the same because you can have various indexes. Yeah. But, you take or you look at the S&P 500, for instance, it will follow the top 500 companies. And as the 499th drops out and the 501st comes in, it will sell out of one and buy into the other. And it will basically just follow the market. So it's not actually trying to overperform. It's not looking as to, whether one particular stock is better than another stock and, increasing holdings in one versus another. It's just tracking and following the entire market.
So what we might do, just to bring it home a little bit, we might talk about something on the Australian Stock Exchange. So let's just to make it really simple, let's just say the ASX top 20. Yeah. So you can get an index that follows and tracks the top 20 companies that are listed on the Australian Stock Exchange. Yep. So in this instance, it would just track whatever the respective performance is of those companies or the value of those companies. Combined together as an index, it would follow and track those. So it's not designed to outperform any of those. It's just basically designed to track whatever those companies do. That's the rate of return that index will get.
Yeah. Absolutely. And compare and contrast that to, maybe an active fund manager.
Yeah. So if you talk about a specific sector, so in this instance, we're talking top 20 companies in Australia, using the ASX 20 as an example. The opposite of the index fund that is just designed to track the performance of those companies, what the active fund might do is it may try or attempt to outperform a respective index. So it may turn around and say, okay, we're tracking, the Australian stock market as an example. Our objective is to try and outperform the Australian stock market, and our target is by beating that by 3 or 4%. And the way that we do that is to not take a passive approach by basically just tracking and following. We're actually going to take positions in the market based on a whole range of different things. It could be buying companies that they believe are undervalued. It could be in companies that they think that, they're coming out with a new technology that they're going to increase and maybe lead the market in a particular area. So it's taking an active decision in terms of a portfolio position because they believe and perceive that it's going to outperform the respective index.
Yeah. So basically an active fund is trying to overperform an index fund, and an index fund is just trying to follow the market.
So I always find that because the world of investing is so complex, we talk about, ASX 20 and S&P this and what have you. The way that I tend to think about it in a really simplistic sense is take property for argument's sake. We're located in Melbourne. If you think about the property market in Melbourne and say, okay, I'm an investor in property, I believe that property is going to do quite well. So I'm happy enough to track the Melbourne property market. So if there was a fund and I could invest in it, it would track whatever the respective property market.
Just happens on aggregate.
On aggregate with everything that sits inside that market.
Yeah.
Versus being an active investor and saying, actually, you know what, I'm going to pick the suburb. I'm going to pick the right or the particular type of property that I believe is going to outperform. I'm looking for the next growth opportunity.
Yeah, you're looking at what street is it placed on? What are the schools in the area? Can I add value to it by renovating?
So that's probably a really easy way to think about it in terms of active versus passive, and then take that thinking and relate that back to the share market essentially.
Yep. Yeah. Yep. And cost is a big consideration. And I think sometimes there's an over-reliance or people have
too much of a focus on it.
Yeah, people focus very much or too much on cost. But, generally speaking, when you're looking at index investing, because you don't need necessarily that expertise around picking a particular, and you don't need that level of detail around picking a particular stock, cost is generally significantly cheaper when you're looking at an index fund versus an active fund, because an index fund is not needing to, do that level of due diligence on the investments. All they need to look at is essentially, which is the largest company, and that's it. Whereas an active fund manager needs to identify those underperforming stocks that are going to perform better in the future and all of that. Now, cost is a consideration, so I'm not trying to downplay that cost is not a consideration, but the other consideration is the flip side is, what's the net return going to be at the end of it?
Yeah, and I think, we have this conversation all the time, and I tend to bring it back to cost is not the only solution or the only thing that you should be focusing on, because I think about, and everybody laughs when I say it, so I'm gonna do it. But think about a car, right? So we drive different cars, right? If it was just a matter of cost, we'd all drive the same car, the cheapest car that we could possibly find, but we don't, because there's more to it than just cost. And just going back, if you think about the infrastructure required to run an active fund, if you're trying to find the best opportunities available for your investors, you're probably doing things like going and sitting in on management meetings if they allow you to sit in there, interviewing key members of the executive team, talking to different people within that industry. So there's a lot of cost associated with understanding that industry and trying to figure out where it's going, as opposed to just sitting back and tracking it. So that's the reason why the cost associated, I think, with the two are so contrasted, because there is a lot of time, effort and energy that goes into try and pick these things. And I guess calling it out and calling a spade, trying to stay consistent as an active manager is definitely a challenge.
Absolutely.
Right? And it's probably no different. We're on the analogy train today, so we may as well use a sporting team. But if you think about how difficult it is to try and stay consistently at the top of your game as a sporting team, it's really difficult, and this is no different.
Yeah, absolutely. And look, diversification is another sort of really big aspect. And it's very interesting because and historically, index funds have been a really fantastic means to diversify because most index funds encapsulate a larger amount of assets than what you would in a traditional active fund. And, you know, it varies. So every fund is going to be completely different. But generally speaking, you know, when you're looking at an index fund and you compare, as Billy's analogy, the ASX 200, which is, you know, where a lot of people are going to be investing in when you're looking at an index fund within Australia. And you compare and contrast that to an active fund manager where usually they're only holding, you know, maybe 20 to 50 different stocks. You would normally think that an index fund is far more diversified. However, when you dig a little bit deeper beneath the surface and you look at, okay, what are the largest assets within Australia? Generally, it's really comprised of two industries. You're looking at the big banks and you're looking at miners. And outside of that, there isn't really any diversification. So you're heavily exposed to two industries by investing in an index fund within Australia.
Yep.
You then compare and contrast that to the exact same thing in the US. And you say, okay, what are the largest assets within the US? Magnificent Seven. What are you talking about? You're talking about tech companies. You're talking about, you know, Tesla. You're talking about companies that are very, very reliant on the tech industry.
Yeah.
And so once you start to delve a little bit beneath the surface, generally speaking, a lot of the times an index fund isn't as diversified as what some people suggest or think that it has been, because the largest companies haven't been so much larger than the rest of the industry in historical terms.
Yeah, no, I think that's well said. And look, in the Australia case, it's really interesting because we are so concentrated.
Yep.
If you consider sort of what makes up our particular composite, it's been that way because you're right, we're dominated by the banks, we're dominated by the miners, and then you could probably chuck in after that the supermarkets as well too. There's not a lot of movement that happens in there. That they've been, you know, I'm sure if we look at the data, that's been consistent the whole time. So if you are in an index, especially in Australia, how diversified are you as well? So yeah, you need to dig a little bit deeper because it's not all as straightforward as what it may seem from the outside. And the thing is, in terms of index style products, there is so many that are available on the market that you can pick a particular flavour. If there's something that attracts your attention, you can invest in that, but it may be skewed to the biggest player or the biggest company, I should say, in that respective industry.
Yep.
And then you might have a few smaller players that sit there. So I think it's definitely well worth understanding what it is that you're investing in and doing your research when you are doing this, because like anything, you need to make sure that you're informed and you actually know what you're investing in.
Yeah, absolutely. And sometimes for some people, it's just ease. I mean, an index fund is simple. It's easy. You understand. It's a lot easier to understand. You don't need to. I mean, if you're looking at an active fund, generally, the active fund is looking at the companies, and you or the financial advisor are looking at the active fund, because, as you said, a team's not going to be on their game all the time. It's not the same teams that win sporting events every single year, otherwise it gets boring. Similar story with, you know, active fund managers. And so you need to be able to, or you need to look at, you know, who's performing well, who's positioned well, who's got the right philosophy, who's got the right management team, and select an active fund manager. Whereas with an index fund, you're basically just, you know, putting it in, and you don't need to track or follow or do anything with it. So for some people, ease is a very big consideration, and being able to just do something without needing to think about it too much is the solution for them.
Yeah. And look, I think that's a really good conduit into the main man, Warren Buffett.
I wasn't going to talk about Warren Buffett. I mean, I couldn't take that away from you.
You obviously, our listeners and our viewers can't see this, but Andrew skipped the dot point, so he could allow me to talk about the Warren Buffett, part that we want to talk about. So, Andrew, thank you for that. Really, see the energy that this has given.
That's just the type of people we are, right? Like letting each other shine.
Much appreciated. So, getting back on track. So, arguably the world's best investor in our lifetime, in our generation, Warren Buffett is an active investor. right? And that's how he's managed to achieve, the level of success that he has. But in terms of what he feels is appropriate for the majority of people, he suggests to people just be an indexed investor.
I think that's actually what he told his wife in the event that he was to pass away. Take the funds and put it into an index.
That's and you know what he's saying is right, because I think for the vast majority of people, if you're doing it alone, I think that makes sense, because the level of knowledge, skill, and expertise to go down the active route, it does take a commitment. Or the flip side, and shout out to our profession and our peers, if you're under advice, it's a different story. But if you're going it alone, Warren Buffett, the great man, basically is a big advocate of saying just put it in the Standard & Poor, the S&P 500, and just let it do its thing.
I'm gonna, maybe rain on your parade about
You're going to argue. You're gonna argue against Warren Buffett.
I'm not arguing against Warren Buffett. I'm definitely not that silly. Is it a superiority complex?
Here we go.
Let's maybe change this into a psychological podcast. A psychology podcast. But is it that I'm such a good active manager that there is no one like me that can outperform the industry that you can trust, and so invest in an index fund?
No. If anybody's listening to that, just scrap the last 60 seconds of Andrew talking. I don't think he's got ego.
No, I don't think so either. I'm just trying to shatter your idol.
But it's a good jovial point.
Maybe not shatter him. Maybe just put an arrow through an appendix or something.
No, I don't think so. I mean, look, coming back to his argument, because I have given this a great amount of thought. But if you think about, and I was actually explaining this to someone yesterday, but if you think about an indexed fund that's represented something pretty big like the S&P 500, the top 500 companies in America, if you think about how a business and how a household and how an individual works. So today this year you earn X amount of dollars. Next year you want to strive to earn more, right? That's just naturally how we're wired. As a business, we hit our targets. Next year, we increase them, and so on and so forth. So when you expand that out into an economy, into more people on the planet, into more people in our cities, into more people working and producing, the GDP that we create as a society increases. If that rings true, right? That everybody's trying to push and do better. And that's just the growth of an economy and the growth of society. Now, if that rings true and you believe that that's the case, then naturally the share market and the businesses are going to get bigger and more valuable. So tracking the respective index and using the S&P 500, if you believe that, in 10 years' time, the world's going to be, bigger and doing more trade, and businesses are going to be, finding more efficient ways of doing stuff and making more profit, then investing in the index, I think that's where Warren Buffett comes from. Yeah. Maybe we should hit him up and see if he wants to do a session on the podcast. Wouldn't that just be amazing, right? if we could pull that off. But don't know if we've got that pulling power yet. But look, I definitely think that's the way to think about it.
And Warren, if you are listening, I was joking. I don't think that you've got a superiority complex. You're welcome anytime on the podcast.
I'm sure he was listening is listening, by the way, right?
Of course.
Yeah, no doubt. Absolutely.
Look, I think another really big consideration within all of this is an age-old saying of, a rising tide lifts all ships. Yeah. So when the market is doing well, when things are good, everything is lifted. There's confidence in the market. There's money flowing into investments. And so as a result, you tend to see index funds do pretty well, or companies within a composite index do well because they're just part of that index. Yep. And you also see the opposite when things aren't going quite so well. And so what a lot of active managers will talk about is that, when things are going well, an index fund may be great, but when things aren't going quite so well, that's when you need to select the companies that are still going to have good profits, that are still going to, be delivering on their expectations to shareholders, because those are the companies that are going to outperform, and those are the years where you've got the ability to, overperform a respective index as well. So, you need to also consider not just, where things are at now, but where things are going to be at a future point in time. And ultimately make your decisions based off market circumstances, your circumstances, and absolutely pulling everything together.
Yeah, I think a really big one, going back to the investment styles, it's when you're on the when you're on the index pathway, you're basically committed, not that you're committed because you can exit your position, but you're basically committed to following whatever the market's doing.
Yeah.
And the reason why I say that is because I want to contrast that with an active approach that in the event that active managers see that there's, some volatility coming up or there's an opportunity or whatever it may be, they actually, have the abilities to be able to position the portfolio to take advantage of that circumstance or to avoid that circumstance as best as they can as well too. So conceptually, I kind of really like the idea that, it's like driving. If you see a hazard on the road, you're going to take corrective action as opposed to index, you're basically just stuck there, right? So I don't know if that really hit home. But I think that's definitely one to call out, that from an active perspective, you can definitely pivot the portfolio in order to try and take advantage of the situation that you're in at that point in time.
Yeah, absolutely. And when you're comparing, performance as well, you also really need to take into account after-tax performance. So a lot of the times it's really simple to just, look at reporting online and there's, this performed at this percent, this performed at that percent, that's a better investment. But the other important thing to consider is, and for a lot of these assets, is what's the after-tax performance? What are the capital gains? What's the environment that you're holding it in? I mean, do you take advantage of things like franking credits? Is that taken into account when you're looking at the net rate of return? And so sometimes, even though it may not be the best performance, so to speak, it's actually the best performance for you after you take into account the tax considerations, after you bundle everything together: cost, tax, performance, absolutely everything, which sometimes people can forget.
Yeah. Yep. No, absolutely. Is there a solution that is the best of both worlds, Andrew?
There may be. So there's a name for it. I don't know how they got to the name, to be honest, but core satellite, whereby you essentially hold a portion of your assets in an index investment. So you're tracking and following the market with, a large portion of your portfolio. And then on the flip side of it, you've got an element of your portfolio that's in an active fund that gives you the opportunity for some overperformance as well. And so it's essentially meaning that you're going to track and follow the market with, the potential upside of a little bit on there. So that's one mechanism that people have used to, be able to get the best of both worlds and not have to select, active or index, but rather have a combination of both. And I think that that's a really great approach. It's not right for everyone, but at the end of the day, I don't know whether it's just us as humans or just the society that we're living in, that you're going to be on this team or that team, and you're either left wing or right wing, and you can't have nuances or you can't have an element of both. Whereas in actuality, it doesn't need to be 0% and 100% or 50 and 50. You can have 10 and 90 or 20 and 80, and you can play in the middle and have some nuance in your journey across investing as well.
Yeah, and I think in our world, when we think about portfolio construction and how this comes together, if you think about a core satellite approach where, say, 80% of your portfolio is invested in the core being an index style fund, then no matter what happens with 80% of the portfolio, you have to be satisfied with, because you're getting the rate of return of the market in aggregate. So you're not doing any better, nor are you doing any worse than what the market has done with, say, in this instance, with, say, 80% of your portfolio. With the other 20%, you're giving yourself a chance to try and reach some of that alpha, some of that outperformance with the other 20%. So if you cock it up and make a mistake, you're only exposing 20% of your portfolio to that, where the vast majority being the other 80% has got whatever the market rate of return is.
Yeah.
I think people feel comfortable with that because they know that there's a managed way to try and take advantage of outperformance without, needing to go too crazy with it.
Yeah, exactly right. And you also need to take into consideration where you're at from a life cycle side of things, where your existing investments are at, where your circumstances are, goals are. And anytime that we're talking to a client around investments, the first thing that's most important is what for? Like, what are you investing for? Is this, a long-term investment that you're going to derive an income from? Is this something that you're going to, use to build up savings, sell and purchase your first property? Is this, what's the purpose of what you're doing? What's the structure? What's the strategy? And then the investments will fall underneath it, rather than where most people start investing is, what's the best investment that I can invest in, when it may not necessarily be right for you. Because in some circumstances, index investing is fantastic. It's easy, it's cost effective, you can pull in, out, and in essence, it doesn't require a whole lot of effort, time, or think work.
Yeah.
But then in other circumstances, you consider some people that have purchased stocks, 20 years ago, and they're sitting on a massive capital gains event if they sell those stocks. Mm-hmm. Mm-hmm. They're deriving a fairly significant income from those stocks with franking credits and all of that stuff. And that's been a fantastic strategy for them. And they're not diversified. They're in, maybe only a few companies, and that is absolutely brilliant. So you need to ultimately have some nuance. You need to make or take into consideration your own circumstances, your own goals, and, the circumstances of the market that you're investing in as well.
Yeah, it's funny, Andrew. And this is by no way intentional, but it always leads back to you need to get advice and see how this fits in, because the construction, the portfolio construction and the asset allocation, the investment approach is relevant, but how does it play into all of your other circumstances? And it's not just the investing piece and finding the most appropriate investments for you and your circumstances, but there's the discipline piece. There's making sure that you've got, the cash flow. Are you investing the right amounts of money to achieve what it is that you want to achieve? Because if you're not putting in that, then you could get a rate of return, but if it's not going to get you to where you need because you're not putting enough in, then there's an issue within itself. So I think to summarize all of that up nicely, I think getting advice is definitely, we talk about it each and every week that we're on the podcast. I definitely think that that's the way to go when you're thinking about this. And because of the complexity involved, it's a no-brainer from my perspective. I just think get advice, and you'll get some more information and knowledge in terms of the investment approach, but you'll also get an expert and a professional that can help you put that together.
Yeah, absolutely. Absolutely. Bills, thanks again for jumping onto another podcast. Always a bit of fun on a Friday morning for us.
That's it, Andrew. And to our listeners and our viewers, hopefully you got a whole heap out of that podcast. Like and subscribe as always. If you want some further information or want to get in contact with Andrew and I, details are in the show notes, and we look forward to catching you on the next one.
Thank you.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.